Hi everyone, welcome to a new week. It's Monday, so it's Market Monday. Time to talk about the stock market and how it's been doing. Well, first of all, if you've been paying attention to the market, you realize that over the past few weeks or days, especially in the new year, the market has been in red. Okay, so far the S&P 500 and the VTI Vanguard Total Stock Market are down about 3% on a year-to-date basis. And my all-time favorite, the Nasdaq 100, is down over 5%. Now, if you're a first-time investor, this would worry you. You're like, wow, why is the market going down? Even seasoned investors as well might get worried and begin to question, why are we beginning the year on a negative, and how long is this going to last? How many more red days are we going to see? Well, this is all due to the high volatility in the market. And volatility just means there's a lot of fluctuation in the price of the stocks and the entire market. So it's going down, going up, going down. But on average, it's gone a lot more down than up. And it hasn't recovered all the way to its all-time highs from last year. So what is causing this volatility in the market? There are many reasons, and many reasons people are saying that is causing the volatility, but I'd like to highlight four main reasons that I believe is causing this volatility. The first one is the surging cases. Lots of cases are coming out now with Omicron. It's very, very contagious, so quite a lot of people are getting it. I actually got it. Just 2 weeks ago, I got Omicron myself, and I was in isolation. And I know like 2 or 3 other people that have gotten it as well in that same time frame. So it's spreading quite a lot. And this is leading to quite a lot of, fear in the market and uncertainty. You see, the market does not like uncertainty. It doesn't like it. Investors want to know what's going to happen and when it's going to happen so they can price it in. But when a new variant comes out, that's something that no one was planning for. So it leads to a lot of volatility in the market and uncertainty. Another reason is due to rising inflation. So inflation, especially in the United States, but even around the world, there are some countries where inflation is up 20, 30, 40%. Just take a look at Turkey. Inflation has gone rampant there. But the United States, for example, inflation is about 7% this year or last year, and they're forecasting about 7% this year as well. And that is not a good thing, because what that means is that your real returns are reduced. So I'll give you an example of how inflation can actually eat into your returns. So let's take, for example, that you have a 10% return in a year, but inflation that year was 3%, which means the price of goods increased by 3%. What that means is that you did not get a 10% return, but you got a 7% real return that year. So imagine if inflation is 7% and you got a 10% return, it just means you actually got a 3% return. And that's never a good thing. Lots of growth stocks, especially tech stocks, suffer during times of inflation. And also the third reason is rising interest rates. So the Federal Reserve has decided to have several rate hikes this year, and that is just not a good thing for the market. The market doesn't like that, especially for growth tech stocks. The reason being the cost of borrowing money for innovation and to expand is higher because the interest rate on money borrowed is much higher. And what this means is only companies that have a huge cash reserve will be able to do very fine. So lots of SPACs, startups, all these new deals, IPOs, you'll see many of them go down significantly. Many of them are like minus 50% already, some even minus 80%. So all those kind of uncertainties is leading to a lot of issues in the market. Another reason why the market has been going down lately is due to the supply chain disruption. You see, COVID has put a lot of strain on this entire supply chain system, which means there's a lot of back orders, a lot of empty shelves out there in stores, in grocery stores and places and supermarkets. Orders are not being met on time. And there are lots of, ships or ferries and containers on the dock just waiting to be processed because lots of workers have COVID now, or they're in isolation or something, So this is really affecting the entire market, and it's one of those things where it's just an unprecedented time. And people are trying to figure out what's going on. But how should you react as an investor? Should you panic? Should you sell? Should you buy? Should you hold? Should you wait? How should you react? Here are 5 ways to react to during times of high volatility. The first one is to zoom out and think long term. You see, if you look at the market just in the last week or month or even year, you may not get a full picture of what the market is doing. You need to zoom out to see the entire scope over the last 5, 10, 20 years, and you will notice that the market is going up. Here is a chart that shows you how the market has been in the last 10 to 20 years. You will notice that there are lots of fluctuations on a day-to-day basis, but overall, the market is actually going up. It's going up, 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 and up. Even when we had severe crashes like the financial crash in 2008, the corona crash and other smaller crashes along the way, you will see that despite those crashes, the market has recovered. In fact, if you invested at the height of just before the corona crash in February, March in 2020, you realize that today you are up. You are higher than it was back then. So you really need to zoom out and take a long-term perspective. Don't just panic in the moment. Zoom out and chill. Stick to your long-term plan of building wealth over the years, not just trying to make a quick buck. Now, the second thing you can really do is to dollar cost average, DCA, to dollar cost average. This means to invest on a monthly basis or at fixed intervals. So let's take, for example, you have 50,000 francs you want to invest today and you're not sure what to do. A good thing you could do is actually to invest 5,000 francs across 10 months. So that diversifies your risk because it allows you to take advantage of the lower bottoms of the market and the peaks of the market. So since you don't know how the market is going to do this year, it could be better for you to just, dollar cost average if you have a lump sum. If you don't have a lump sum, then just keep investing. Just invest every month. You're going to be fine anyway. Just invest every month. Dollar cost average, what it does is it gives you the average of the entire market, so that you don't just buy at the peak and then wait for a recovery if the market was to crash today or tomorrow. So I highly recommend for you to do this. Number 3, don't panic sell. You see, quite a lot of people worry, and when they see the markets going down, they begin to panic and they want to sell very quickly because they don't know what to do. Don't panic sell. That's like selling at a low and then buying back at a high. It's never a good thing to do. In fact, you will miss out on a lot of gains because no one can predict the market. I know lots of people on YouTube think they are financial gurus and can predict the market, but no one can. We don't know how the market is going to do. The market is shut today on Monday because of Martin Luther King Day, but tomorrow it's going to be open. Who knows what it's going to do? On Reddit, lots of people are betting, it's going to be red, it's going to be green, but no one knows, right? We don't know. So don't panic sell and think that the market is going to crash anytime soon. Just stay invested, and that way you get the most out of it. Number 4, which is the most important, is to understand this major principle, which is time in the market beats timing the market. Time in the market, so being invested in the market and keeping your investments there, beats trying to time the market, trying to predict when it's going to crash, when it's going to rise. You don't know. Let me give you some statistics to prove this. If you missed the 5 best days in a 10-year period of investing, your returns will drop from about 12% down to 5% annualized returns. Think about that. You halve your returns by missing just 5 of the best days in the market by trying to time the market. Now, if you increase it to 10 days, if you miss 10 of the best days in a 10-year period, in any 10-year period of investment, your returns drop from about 12% to 2%. 2% in the market in a 10-year period. If you miss anything more than 10 days, you actually have a negative return. That's why you have to stay in the market. You have to stay invested. Don't try to time it. Don't try to say, I'm going to buy today, I'm going to sell today. Don't do that. Just stay committed. Buy every month at the same time and stay in the market. Don't try to time it. Okay? Now, the last one is for you to just chill. See, investing is about long-term wealth. It's about building sustainable wealth in the long term. There's no reason for you to be panicking on the day-to-day basis. Don't worry about the news out there. Don't stress about what people are saying. Just chill. Just stay in the market, stay invested, turn off your app, sign out and don't check it 3, 4, 5 times a day. Even on the weekends, there's no good for that, right? This doesn't help you in any way. So just chill. Remember your principle and stay invested in the market and chill. Just rest, spend time with your family, do other things that are valuable to you. The point of investing is to take away your stress, to make other people work for you, not for you to add more stress to your life. Okay? So here is a quick recap of what we've talked about today. Number 1, remember the long-term perspective. Zoom out and think long-term. Number 2, dollar cost average. Invest at fixed intervals. It could be once a month or once every quarter. Stay invested like that. Number 3, don't panic sell. Don't, pack everything, sell it, and then leave, and then say you try to get back another time. Don't do that. Stay invested. Number 4, time in the market beats timing the market. And lastly, chill. Just rest. It's going to be okay. We're all going to get through this time. The market is going to recover. Just keep investing. And now is the time to buy the dip. Keep buying. When the market is red and down, keep buying, because then your returns are potentially greater. So thank you for listening today. Please don't forget to subscribe. I'll appreciate if you do. It helps our channel grow. Thank you very much, and hopefully the market is growing this week. I think everyone would love to see that. Have an amazing week. Bye.